Hey guys, this is Max Convexity. Hope everyone's having a great evening. It's about midnight in the central time zone. I wanted to take a look at the stock index futures. We had a pretty nice sized drop in the indexes today, and I want to take a live look at the stock index futures and see how they're trading overnight. All right, so as I always remind everybody, the first three, because that's the most important thing to me, is the price of the NASDAQ, the price of the S&P, and the price of the Russell. So the top three things on my chart are always those prices. Now these are futures prices, so these stocks, or these are futures, they aren't stocks. They trade 23 hours out of the day. But these futures are what drives the price for the indexes that we trade. If you own QQQY, you're also ostensibly trading the NDX because the QQQY trades NDX on your behalf. Same thing with JEPY, they trade SPX, and the same thing with IWMY, they trade RUT, or the Russell 2000 index. So that's why it's paramount importance to keep up with the stock index futures, especially overnight, because the stock indexes themselves, like SPX, NDX, and RUT, they don't trade at night. So the futures is all you can see at night. All right, look over here at the far right column. This one says 0.82, and it's green. So look, the Russell was down at 1.5 today, and it's already recovered half of what it was down. The NASDAQ and the S&P have also recovered, but not to the same degree. Let's take a look at these. Let's take a look at these futures and see how they're trading right now. Well, that's not the right one. Ignore that. I typed in the letters in the wrong order. Okay, you can see the big red bars are this afternoon's drop. And then what happens? After that happened, in the market's closed between 4 and 5 every day. It's closed for 1 hour out of the day. The futures all trade 23 hours. That they do not trade between 4 and 5. So after they reopened at 5, well, guess what? People came in and were buying them back up again. That's the Russell. Here is the ES, which is the S&P. It's back up. The symbol for the S&P futures is ES. I use them interchangeably. I'm not trying to confuse everybody. I'm trying to work on making my vocabulary, and not really know so much my vocabulary. I'm trying to work on defining, whenever I use a jargon word, I'm trying to work on defining it better before I use it. I know this options, they're pretty complicated, and they have a whole new vocabulary, and they have words that you use in options that you don't even use other places, like convexity. Well, you use that in math a little bit too, in physics, but convexity is an example, or delta, and there's a ton of them. But I'm going to try to do a better job going forward, not using so much jargon. I would say it's encouraging that the futures have bounced. We'll see what happens by the morning. I just wanted to check in. Now, I also wanted to talk about tomorrow's options positions. And look at the spreadsheets a little bit. I have the break-even prices, and I have some information for tomorrow. Okay, let's start with the QQQYs. They sold 161 contracts. Always read from left to right. They sold 161 contracts, and they sold them their put options, and they sold them at the 16,640 level. A put option at the 16,640 level, that means the 16,640 is also called the strike, but that is the level that if you buy the option, if you buy a put option, it's an agreement to sell the stock. So it's a bearish play, and the agreement is you sell it at whatever level the strike is. So if you buy the put option, you get to sell the index, the NDX, at 16,640. So a buyer of a put option wants the index to go down. If the index drops 100 points in one day, the buyer of that contract will make that 100 points. What these funds are doing are they are selling puts, and selling puts is the opposite of buying a put. So the buyer of a put is bearish. So that means the seller of a put is bullish. So when you sell a put, it's a bullish play. So you're selling it to somebody that bought it. So the guy that bought it is thinking that it's going to go lower than the strike level, which is 16,640. The guy that bought it from you. You, since you sold it to him, you're saying no, it's gonna be at this level or above. You're making a bullish bet. The strike is important because it's the number that you use to figure out who wins or not. It's the number that I'm having a hard time describing it. Somebody please help me in the comments. I'm going to make another video tomorrow, but the strike is the level of the option where the option becomes useful to the person that bought it. If it's a call option and the strike is at 100 and the person buys the call option, they're betting and they're able to profit on if the stock or the index or whatever the option's on goes above 100. The seller of that call option is hoping the index stays under 100. The buyer of a put option, let's just say the strike price on a put option is 100. Somebody that buys the put option at 100 is hoping for lower prices. If the market drops to 90, that put option will be worth the difference between 100 and 90. That put option would be worth 10 points. The strike level is just the level that the two parties are betting on. And that's the level that and you need to have a strike level so you can determine how much money one party makes and the other party loses. Let's go back to my fictional example at 100. If somebody buys a call at 100 and then the index the next day goes to 110, that person made 10 points. And the person that sold the option to him lost 10 points. If it's a put, it's just the opposite. Selling puts is what these indexes do, and it's it's very complicated and convoluted to explain. Most people, it's a simple concept to understand, hey, I'm bullish, why don't I just buy a call? Because that's also a bullish play. You can buy a call option, and that expresses a bullish view, or you can sell a put option, and that expresses a bullish view. The detail is in the mechanics and how they work, and that goes beyond the scope of tonight's conversation, but I'm going to make a from the beginning video on options. So these guys sold 161 contracts on the NDX. The strike level, the strike price is 16,640. Strike price is also max profit. We received, or the fund managers received, 99 points. So you subtract 99 points, which is max profit, from the strike level, and you get 16,540. So that's break even. We're going for a total profit of $1.5 million. Another way you could come up with the $1.5 million is you sold 161 contracts. Each contract was $99. So you multiply 161 times 99.07, and then you multiply that number by 100, and you get 1.595 million and 27 bucks. So that's the profit we're going for. So what I do next is I take that number and I see what percentage that number is of the overall fund size. This is how much the fund is worth today, $259,770,000. So on a percentage basis, $1.5 million compared to 259 is 61 basis points, or 0.61%, or 61/100%, however you want to think about that. You can also take this $1.5 million and you can figure it out by the shares outstanding, and you can figure out how much that equates to for each share, how much profit per each share that would equate to, which comes to 11 cents a share. You can see on the line above, we lost 25 cents a share today, which is the same thing as 1.38%. They're the same thing. Some people like to think in per share, and some people like to think in percentage. I like to think in percentage. Per share is good too, because per share is literally, if they decided to give you all the profits, and they don't, they usually just pay 90%, but just in theory, you could add up all these per share captures, and I think last time I checked it was at 58 cents or 78 cents. It doesn't matter, but you can add it up at the end of the month, and that 78 cents or whatever it equals, that's your dividend. That's what the dividend's going to be. Sometimes they keep some of it back, and there's a few other factors. They also make money from interest, so they have to add that in. But usually, like I say, they just pay you a portion of it, about 90%. So I think it was 70 cents the other day. So just say if it ended at 70 cents and they paid you 90%, your dividend would be 63 cents. I mean, it literally be so I can see why people like to think in per share, because that you can almost equate that to a dividend. But you can also equate a capture to a dividend, which is the way I prefer to think of it. I take all of these captures and I average them. And that number goes right here. See that average daily capture? And that's even after losing 1.38 today. We're still averaging a 19 basis point, or 19 100ths of a percent capture. So, and that's each day. So then this number down here figures out what your annual dividend would be. And all I do, this is your daily average capture. So I multiply that number by 250, and that's what percent your annual dividend would be. So at the rate this one's going right now, it could pay about a 46% annual dividend. Because a lot of people like to think in those terms. What kind of yield does this fund have? And you could say the 46 is the yield right now. But you could say this per share, whatever it was, 70 cents or 80 cents is what I said. Or no, I said 70 cents, and then it would be actually 63, because you would take off 10%. Yeah, for the 63. So that you can look at your dividend as, hey, it's going to be 63 cents. Or you can look at your dividend, hey, it's going to be, well, whatever it's going to be, it's going to equal out about to a 46% per year yield, which is pretty good. I like to think of percentages, but I keep the per share numbers right next to the capture. Sometimes I don't emphasize them enough. I had a comment about it, and I'm sorry. I'll try to start emphasizing the per share price also, even though it's telling you the same thing. It's just a different way of looking at it. But I understand, different people have different ways of thinking about stuff and different learning styles. All right, so let's look at these other ones real quick. Okay, JEPY. These managers, I have it up here in the corner, SPX. This is SPX. These managers sold 220 SPX puts, and the strike price was $47.25. So they're selling the puts. That means these guys want the market to be at least at $47.25 or higher. That's what they want. And the person that bought these 220 puts from us is thinking the market's going to be lower than the strike price. All right, so we earn $29.47. That's what the buyers of the puts had to pay us. So the total profit we made was $220 times $29.47, and then multiplied by 100. I don't know why I say times. That doesn't sound very intelligent. 220 multiplied by 29.47 multiplied by 100 gives you this number, 648,340. So that's the total profit we're going for. And the strike price is also the max profit, so it's another way to think of it. If the market closes right at $47.25 tomorrow, we'll realize the max profit and we'll earn $648,340. Also, if it closes above $47.25, we'll earn max profit. These two numbers, max profit and break even, are important because they carry through to the spreadsheet. Or, I mean, I'm sorry, they don't carry through to the spreadsheet. They carry through to the profit boxes. And I just remembered I haven't done the profit boxes yet, so I'm going to do one while we're talking, so you can see how I construct these. So I look at the spreadsheet because all these numbers are real things, but I also try to tie them to something visual. So all this is the strike price minus the price of the option equals the minimum profit or the break even. So for my profit box, I need to draw a line at 47.25 and then a line at 46.95. So I get this little tool over here. Darn it. I'm sorry. I get this little tool over here, and I already forgot. That's the thing. I need to make a system that does these automatically. I'd like to write a program that can do this automatically, but I don't know how to. 47.25. All right, that's the main number. All right, so I go here and I find 47.25, and there it is right there. All right, and so then I draw a straight line. And then, okay, so then I know that the break even is 29 points away because that's what the option cost the buyers. That's what they paid us. So I go down 29 points. Let's see, did I do that right? Now, let's see here. All right, so I'm just going to go back and instead of trying to do it on the fly, 46.95 and then go up. All right, 46.95. All right. I also do something that I'm not going to talk about in this video, but I separate the boxes into intrinsic and extrinsic capture. But since I haven't even defined those yet in this video, it's not important. Just know that if the market closes anywhere in this box tomorrow, it's a profit for us, for the people that own QQQYs or JEPYs. If the market closes on the bottom line, it's a break even. If the market closes on the top line, it's a total profit, which was, what was that? $648,340. And also, if the market closes anywhere above the top line, it's also a max profit. If it closes anywhere under the bottom line, that's where the losses come in. Look at today. As soon as it started going under that bottom line, the losses started piling up. And if you want to look at it, all that is that it went, see that $71 to close? That means it went 71 points under that bottom line. That's what that means. That's also what it cost us to close. But if you look over here, premium received, we received $10 for that option, not even $9.52, and had to pay $71 to close it. It was not a great day at all. But the reason we had to pay to close it is because it went under the break-even line. Hopefully that won't happen tomorrow. Let's look at the IWMY. IWMY, we sold 299 contracts. The strike price is $2,000. We got $25 for them. So you subtract $25.98 from $2,000 and you get $1974.02. That one's pretty straightforward to figure out. So we're looking for the market to be between those two numbers, or above them would be fine too. Since it's a bullish bet, we're all right if it goes above them as well, because it is a bullish position. But ideally, we want the thing to go right to 2,000 and stop. Okay, These guys are going for 776,000, and just to refresh everyone's memory, that's 299 times 2598 times 100 multiplied by 100. You get 776,000. Let's look over here at the. Let's look over here at this. And you guys are in luck because I forgot to draw all three of these boxes, so I'm going to draw them live. So you guys can kind of see behind the scenes and the inside baseball how this works. All right, so we need a line that goes from 2000. The top of the box should be at 2000. The bottom of the box should be at 1974. So easy peasy, right? Get that, and let's find 2000. Bottom line needs to be at 1974. That was a good year. I was 8 in 1974. How old were you guys in 1974? Probably a lot younger, or probably not even born yet. All right. It's a little bit crooked, but it'll do. Close enough for government work, like my mom and dad always used to say. All right, so that's the profit box for tomorrow for the Russell, or ostensibly for the IWMY, because that's what we care about. But if somebody that sold that option, this would be where they would make a profit. The top line is maximum profit. So if it closes on the top line or above, it's $776,000 winner. The bottom line is break even, and when it starts going under the bottom line, then we start losing, and that's when we're going to have to pony up, and we're going to have to pay more to buy the option back than we sold it for. Remember, a lot of people aren't used to thinking in terms of shorting stuff. Generally, people that short stuff are just hedge funds and very sophisticated investors. Most ETF investors don't think in terms of shorting things, but you have to learn about it when you sell options, because when you sell an option, it's a short position. You do the sell first, then you still have to buy it back at some point in the future. For every sell there's a buy, for every buy there's a sell. You have to offset the transaction. But when you're shorting something, you get to sell it first. Okay, let's see. Let's go over here to. Let's look at this last chart here. All right, I don't have the profit boxes for NDX, so let's look at those. I don't know if this is helping people. I hope it does. Okay. So to review, we sold 161 contracts. The strike is 16,640, so that's our max profit. We received $99.07. So you subtract 99.07 from 16,640, and you get that number right there. So that's what those two numbers are all we need to draw our profit box. It doesn't matter how many contracts they sold for the sake of the profit box. The only reason that contracts come into play is when I'm calculating at the end of the day, whenever we settle somewhere and we're trying to figure out our profit, or even at the beginning of the day when we're trying to figure out how much profit we're going for. These guys are going for a lot of profit tomorrow. This is the second highest one they've ever gone for. They went for $1,521,000 on the 8th of December, and they got it. They made it that day. But so this is an even higher amount that we're going for. So it could be a huge winner tomorrow if the market cooperates a little bit. And by market cooperating, I mean we need the NDX to close at least at 16,540 so we don't lose money, and as close to 16,640 or over it as possible. All right, let's get on to the profit boxes. So 16,640, and it's basically 100 points long, 100 points big, or 100 points thick, or 16,640. 16,640. Right there, let's see, 16,640. So 16,540 would be the bottom line. I need to find that. Close enough. Because the profit boxes aren't official. They're just for visual representation. If I don't draw the profit box on exactly the right line, the spreadsheet's still going to take the correct numbers and figure out the value at the end of the day, and so we can estimate our dividend, and so we can track how we're doing. Okay, so that's the profit box for NDX. So now we've got everything done. We have the 3 profit boxes drawn. We have the spreadsheets done and waiting for tomorrow. We know how much money we're going for. We know where the market needs to go. So hopefully tomorrow, nothing should surprise us. If we lose money, we'll know why. And if we make money, we'll know why. I would say, though, it's encouraging that the futures are going up. Let's flip back over here to the futures. Here's the Russell 2000 futures. So that's, first I'm going to show the Russell itself. Okay, here's the Russell itself, and here's the Russell 2000 futures. Just so you can see. So yeah, it's made quite a bounce. Same thing, we'll look at the SPX, which is the S&P index, which only trades during business hours, and then we'll look at it right after that. We'll look at futures so we can see. See that? That's nice. It's going the right direction. All right, so here's NQ, or I'm sorry, here's NDX, regular hours trading. Went down, closed on the lows of the day. And here's futures. All right, guys. Well, I appreciate everyone listening, and I hope this wasn't too in the weeds. I think I might start doing these nightly updates. They aren't always going to be this long, but I think I might start looking in around midnight before I go to bed and showing everyone where the futures are trading at that time. And then when I get up in the morning, I usually about 8 o'clock, I do another update, and then I'll do one at noon. So we can monitor this and get a handle on it. I just want, my goal is for everyone to understand how these funds make and lose money. My goal is not to turn everyone into an option trader. Selling puts is kind of, it's hard to explain, and it's not for everybody. That's why these funds are so perfect for people that don't want to or don't need to know all the details, and they aren't worried about the delta, or they aren't worried about any of the jargon. They just know the odds are in their favor. When you sell an option, you win about 2 times out of 3, and the fund is going to do that to pay them a dividend. All right, guys. Well, I'm going to let you go. You guys have a great evening, and I'll talk to you in the morning.